So here we're looking at supply on the left, demand on the right. So supply, as we mentioned before, is a representation of sellers, whereas demand is a representation of buyers. So if we ask ourselves the question, who is selling here? Okay, the answer would be the institutions, and then the next question will be, well, how do we know that? And the answer to that is, well, we don't. In truth, we never really know if it's the institutions who place the order, or it could have been Warren Buffett for all that matter. I don't really know. But at the end of the day, if we have the belief that the institutions are the ones that control the market, and I absolutely believe that, but if that is the case, then who else can create entire market turning points? So the problem with the retail traders doing that is, even combined, we don't have enough money and all agree at the same time, right? So that would literally mean that we would all need to pool our money together, and not only do that to have a lot of money, but then we would have to make the same decision and agree on it. As we know, that can be difficult, right? It's very difficult to agree on things, especially when you're dealing with money. But the institutions, they're not millions of retail traders. They're individual entities. So when an institution already has all of that money, they come in with one decision. They don't have to worry about John over here agreeing with them, or it just doesn't matter. They're making one decision, and they do have the money to actually turn the market. So that's why we say that the institutions are the ones to keep an eye on. Now the next question we want to ask ourselves, we ask who is selling from the top. We also want to know who's selling from the bottom, right? So after we see that strong decline in price, who is it that's jumping in and selling, right? We would say terminology such as chasing the trend, things to that nature, okay? So the answer there is the beginners. Typically, your beginners are going to fall into the retail category, unless, for example, they've gone to work for the institutions or something like that. But beginners are your common trader who is going to chase a trend after it is already underway. Okay? Now, unless they have a strategy for doing exactly that, obviously. So there's always exceptions to every rule. But typically, the beginner is going to be the one that waits for a major decline to take place, and then they're going to make their decision after the fact. Okay? It's unfortunate, but it just is what it is. And even the absolute professionals, I mean, it happens to everyone. It's not like we can say that's never going to happen to any of us. I mean, it always will. We don't always get it from the beginning, and so on. So it will happen, but at the end of the day, we certainly don't want to base our decisions on that. Okay? So let's ask ourselves the next question. Who's going to be buying? So please remember that this arrow here is pointing to the exact same location at where we just specified that the beginning sellers are taking place, or beginner sellers, I should say. So if the beginner sellers are stepping into the market after the fact, remember what we talked about with that transaction. Remember, there had to be two sides to every transaction. So in this case, who are they selling to? You got to ask yourself that question. And remember the remaining part of the transaction. He who holds the most wins. So what ends up typically happening is the beginners will sell after the fact, but what they don't realize is that they're selling right into the hands of the institutions. So that's who is buying from them. Now we would ask ourselves the same question, but I'm sure we already know the answer to this. So who's buying after the trend to the upside? Of course, that would also be the beginners. Typically, those guys would be buying right into the hands of the institutional sellers. Okay? So it's that transaction, guys. I've just seen it so many times over the years, and it causes so many emotions and frustrations and so on and so forth. But it is what it is, and just like we saw, I'll give you guys a little bit of information when we get onto the live charts. I'll show you what we discussed today in the room and things like that. But we literally left the room with one scenario. That we were looking for. We did the same thing yesterday. As a matter of fact, I'll point both of them out. So there are lots of different types of traders. There's some who are looking for everything they can get. It's like they want to pull every apple off of the tree. And then there's some that want to pull only the ripe apples, right? They want to wait for the high probability, larger reward scenarios. So, not a wrong nor a right, guys, right? Let's move forward, keep going real quick. So what we can do here with a rectangle is define those areas. Okay, so a zone, obviously most of you have probably heard of supply and demand zones. So for those of you who were typing in no at the very beginning, what we're going to be looking at today is zone theory, okay, and we're going to be using a zone or a rectangle as a graphical representation of where we anticipate market turning points to take place. Now, it's very important that we understand that as we are going through this stuff, that's not to say that we're talking about a complete reversal every zone you see. Okay? That's absolutely not the case. It's just where high probability market turning points are likely to occur. And not only turning points, but pullbacks. Okay? So let's get out to the charts before we get too far into that so it makes sense visually. But all we're saying here is we can give it a graphical representation by simply using a rectangle. You could also use two lines, two rays. NinjaTrader has great draw tools to use, so we can certainly utilize those.